Mortgage rates are rising, and it may cost you thousands of dollars per year if you don't prepare to do the right things the right way. So if you're needing to make a move in 2022, stay tuned and take notes. Hey everyone, my name is John Lahey. I'm the team leader of the Fine Living Group, a local real estate team here in the DC metro area. Let's talk a little bit about mortgage rates. Here we are at the middle of February. Certainly we've seen a rise in mortgage rates in a volatile environment. So I'm going to cover with you today where we are at today, but certainly as we go through the months, we're going to keep you updated on what's happening with mortgage rates as well. So let's start right here. Sam Cater from Freddie Mac says mortgage rates remain unchanged from last week. The economy lost momentum in January, leaving mortgage rates unchanged from last week and relatively flat for a third consecutive week. The stagnation reflects the economic impact of the Omicron variant of COVID-19, which we believe will subside in the coming months. As economy and the economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. And in the meantime, recent data suggests that home buyer demand continues to be elevated as supply remains low and driving higher home prices. So this statement came out the day before the jobs report on Friday last week, right after it, and certainly I think a positive jobs report hints to the Fed taking action and raising the Fed funds rate in March. Expect to see rates go up. We're up at about 3.55% on the average 30-year fix. It's reported by Freddie Mac, but no doubt a volatile January leading into February that I believe we'll see more rise in rates, and that's what we need to be prepared for. If you're looking to buy, you need to be prepared for that. So my goal for the next few minutes is to give you what you need to be prepared for if you're looking to buy or sell real estate in 2022. So if we look at this rise in rates, we're at about 3.55, a little bit higher percent. And this graphic goes back to the beginning of 2020. And we're starting to get back in the area. We're back in the area of where we started when the pandemic came on us in March of 2020. Just to put that in perspective, the Fed comes in and acts the influence. They don't control mortgage rates, but they influence the rates down, and now we're back, coming back up. Certainly a sign that we can all hope for, that the economy is improving, that we're getting through this and we're moving ahead. That would be my word for it. Now, if you take a little bit larger look, I'll go back to the beginning of 2018, which is what this graphic shows on the average 30-year fix, and sort of make this line of 3.55%, you can see where we sit there, right? Certainly we're higher back in 2018, and 2019 started to come down and certainly dropped to historic lows during the pandemic. And we're starting to come back out of that. So perspective on that. Again, from Freddie Mac, as mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. No doubt, we'll see a housing market that is competitive this year in 2022. It goes on to say, in 2022, we expect purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022, which refinance activity is anticipated to decrease from 2.7 trillion in 2021 to 1.2 trillion in 2022. All right. So why is this important, you may ask? Look at the two mortgage markets. You have the purchase market and you also have the refinance market. All right. So purchase market is forecasted to grow while the refinance market is forecasted to constrict. That makes sense, right? In a rising rate environment, everybody had the chance. Maybe not everybody. There will still be some refinances, but most people refinance already at a record low rate the last couple of years, and good for them as homeowners to be able to do that. But we're going to see volume constrict. Why is this important right now, you may ask? Well, you know, if you take this rate of 3.55% and even going into 4%, and you start to see that already right now, which I think we'll see very soon. That's still a very, very favorable rate when you go back all the way to the 70s. This is the average 30-year fixed by decade, all right? Going 1970, 1980, 1990, 2000s, 2010, and what do you see there? At 3.55% or even at 4%? Very, very favorable financing when you look historically. Now, you know I've mentioned it before. Between 2010 and 2020, we bounced around 3.5 to 5%. It was really the range of interest rates during that time. So you see the average rate here, 2010 of that decade of 4.09%. It's very, very good financing. So it's going to feel like we're heading higher, but when we look historically, it's all about perspective. Still very, very good financing for homes across the country. And this is the 10-year Treasury yield. This is a look at the 10-year Treasury. Going back to the beginning of December, just 2 months ago, all right? And what do we know during that time? What do we know? During that time, the rate on the 10-year Treasury yield has skyrocketed, all right? Knowing on the door right now of 2%. And why is this so important? Here's why it's important. For the last 50 years, the relationship between the mortgage rate and the 10-year Treasury yield has been almost symbiotic, okay? And wherever the 10-year Treasury yield goes, there goes the 30-year fixed rate, okay? So the Fed raising rates does not control interest rates. It can only help to influence it. What we want to watch is the 10-year Treasury yield. Why is that? Because over the past 50 years, there's been that relationship between the 10-year, all right, Treasury and the 30-year fixed. And I'm staying on top of this. You know, even to take this a step further, what I would do is I would look at where we started the year, which is at about 3.1%, where we're at right now at 3.5, maybe 3.7%, and where we're going, you know, it's going to be 4%, most likely higher than that. And I'm not saying we're going to stop at 4. I don't have a crystal ball, but that's certainly the outlook. I would take the average loan amount in your area or whatever you want to buy, and maybe you get this from your lender. All right, have them do the calculation. What was the payment at the beginning of the year? All right, what's the payment at right now? And then have them calculate what's the payment at 4%. It's going to show you the real impact of moving interest rates and really the real cost of you waiting. You don't want to convince anybody to do anything that they don't want to do, but we want them to be educated on what's happening in the markets. And that's what's happening right now. Now, I'm going to end on this slide right here. Mortgage rates hit their highest level since March 2020 and leading to the slowest pace of refinance activity in over 2 years. You know the market. In the last few years, the mortgage market certainly has had a ton of refinances in it. And those are going away. And my advice to you is to have great partnership, great lenders, great real estate agent, the kind that will really serve you the best way possible. So I'm going to wrap on that note. So I hope this gives you insight on the current real estate market and the mortgage interest and the mortgage interest rates. Have a great day, everybody.